Hey, welcome to the show, Total Financial Solutions, Safer Money Hour. I'm Arif Halaby along with Jeff Gerard on your place for news, talk, and information. This is AM 1220 KHTS. We're talking about, some of the things that we find in life is that, as we age, as we get closer to retirement, as we start becoming empty nesters, right, they say, which is the kids are growing. You're now in a position to have less of them in your home, which is sometimes a good thing. But it's also a time for you to have a few others of the decisions, financial decisions that really go down the road of, does it make sense to carry life insurance in retirement? Now, I'm going to give you a real life example of some issues that we had just recently. And I think it's important that you know this, because part of what happens is to make the right decision. This is real. This is really people's lives. And here's a great example. Husband and wife both work for a school district, different districts, but still a school district, where they have his pension and her pension, saving a little bit for retirement, but they were busy putting children in college and paying off debt, and sometimes we make mistakes financially, so you kind of step backwards before you go forwards. And then you think, I'm going to work 5 more years. I can't tell you how many times I have had people tell me in their retirement years, or just about, Jeff, I don't plan on dying.
That's right.
Yeah, I'm good. I'm healthy. I don't plan on dying. Yeah. For some reason, we have had this rash of people having strokes that are in their 50s and 60s. And then this gentleman passed away in his 60s, early 60s, planning on working a few more years. But, I don't know, in 2012, I guess, whatever, 5 years ago, said, I don't need life insurance anymore. I just don't plan on dying. I'm like, well, okay, I guess that's weird. How many people do? But there's reasons to buy life insurance. Not always. You don't always need it. Sometimes it's an expense that you don't need. But at least consider a term insurance plan for a period of time, even just a 10-year insurance plan, even a 15 or a 20, something for a period of time where you can say, look, I have this plan. It's got a purpose in life, which is to fill the gap until we fill up our retirement accounts, or until we pay off the vacation house or the primary house or credit card debt, right? There's a lot of reasons to have it for the periods of time in our lives.
Right, and I think you hit it on the head, saying that you should have some type of coverage, because in this scenario, what you've illustrated, the best thing you can do is die.
Yeah, isn't that sad?
That's terrible. And some people say, because back to what you said earlier, people say, I'm going to live forever. They also think they're going to work forever.
Mm-hmm. Yeah.
The best thing you can do is die with a life insurance policy.
And that's sad when your life is built so many years of working. Do the math. Do the math for you and your family, and sit down and say, what if I have set aside, what if I've made $50,000 a year? $50,000 a year for 20 years. Certainly you've made less over times, maybe you made more. But if you do the math on 55 times 2, 50, that's $1 million in cash has gone through your hands in the last 20 years.
Right.
$1 million. And how much of it is in your bank account, right? Everybody thinks, I just have to make more money. Well, you've already made more money. What have you done with that?
Right.
I just have to win the lotto. No, you already have. It's called a pay raise, and it's bonuses, it's pay increases. What's happened to that? So how do we make sure that if you're building your assets in your retirement account, that you end up keeping more of it? And I think you're going to do that in a couple of ways. And one of those specifically is by making sure that you have life insurance just for the period of time you need it. But understand you might need it longer than you think, right? Just don't say, I don't need it anymore because my kids are grown. No. Is the house paid off? Can your wife live on half of the income, or whatever income is going to be gone when you die, right? Those are big issues.
Right, and we've spent whole shows talking about this, and I'm glad we're getting into some of these details, because I think part of what people miss is they're only looking at the eye-opening media when the celebrities die. When someone dies at 61 or 62, 58 of a stroke, something sudden, they say, oh my gosh, I can't believe that. Look how young they were. Look how this, look how that. But they forget about all the stories that other people have, and all the other families that have lost someone early on unexpectedly, and it left a tremendous financial gap in their family's finances. So taking a look at this, I think this is a great opportunity for you to learn some things about why you should keep life insurance. And like you said, Arif, it's not just to cover the gap while, my kids are out of college, or, the house is paid off. What about your retirement income?
Yeah.
What if you pass away and the only reason those checks are coming in is because you're still breathing?
And now you have Social Security even affected, of course, by it. So if, for example, you're getting a $2,000 Social Security check, your spouse is getting a $2,000, and everything is great, $4,000 a month, you can live kind of nicely on that with a little bit of pension, maybe some savings. If your home is paid off, everything is great until the time comes when one of you pass away. Then you only get one of those Social Security checks. The other one's gone. And you now have a choice with one Social Security check. How are you going to live for the rest of your life when your income has dropped substantially?
Well, no problem, Arif. I'm going to sell my house and take the proceeds and just live off that. I'm going to downsize.
And you're going to see that. A lot of people think that is the answer. We say, not a problem, as long as you understand that your most comfortable thing, which is your home, is now gone, as well as your spouse and your friends, and maybe you can't afford to live in the same community or buy another house the same price that you have, so you now have to downsize from a home into a condo or maybe rent an apartment.
Right. And also assume that your house is at a value that's going to make sense to sell it.
That's right. Sometimes people have taken equity out of the home, paid off credit cards and car payments. They've been on a payment plan, a 15-year mortgage or something that says, I just don't know when I'm going to die, but I can tell you when I'm going to pay off this loan. Well, what happens first? Look, the chances of people dying are small. I understand that. But I don't know why we're in February, I guess almost March, and we have had a couple of clients die in just a short period of time. It never used to be that way. It used to be we would go 10 or 15 years without having somebody pass away. So the real effects are behind the scenes. It's making sure the family can still live the way that they want to live, making sure that you're not affecting the spouse to have to retire or relocate or move or change their lifestyle substantially. So we're going to come back in just a minute. When we do, we're going to get into some details here on some of the reasons that people don't buy life insurance. So how do we make sure that we are set up so that we avoid these reasons? See if it matters to you. See if it's the problem. Maybe we have a solution, because we're Total Financial Solutions, Safer Money Hour. I'm Arif Halaby, and that's Jeff Gerard on AM 1220 KHTS. Hey, welcome back to the show. Total Financial Solutions, Safer Money Hour. I'm Arif Halaby, along with Jeff Gerard on your Safer Money Hour. Total Financial Solutions, we're talking about some life insurance issues. I kind of feel compelled to bring this to you, and Jeff, as we're talking about this, because a lot of people don't realize there are times in our life when we might need it. And let me give you a little bit of a background. There's some really inexpensive ways to still insure you and your family. It's just called term insurance. That means you die, they pay, just like car insurance. If you didn't die last year, you're not going to get anything extra. It doesn't work that way. If your car insurance, if you didn't crash your car, you don't get paid, to buy a new car. So there is still, it's just pure insurance. It fits the needs for most people's insurance needs, which means I only need insurance until my youngest gets out of college and then we're good. Or I only need insurance until this period of time when my car is paid off, or when I only need insurance for a period, right? So that period of time that you need insurance is what a term insurance plan is for. But where does that come into play when you're trying to build income replacement? Consider buying life insurance. Here's some of the reasons that people don't buy it. They think it costs too much money. They think they can't afford it. But that's not always the case, right, Jeff? I mean, look, a 20-year policy can be little as $25 a month.
That's right. And it's really all going to come down to how healthy you are, how old, or if you want to call it, how young you are. Because we say this: buy insurance. If you have a need, an insurable need, buy as much insurance as you can within your budget for as long as you can, because this is probably the youngest and healthiest you're ever going to be.
Yeah.
And you don't get to go back in time and say, oh, wait a minute, I needed it. But no, if you get sick and you don't qualify and you didn't buy it when you did qualify, then you're kind of out of luck.
And you know what else happens that I think is kind of unique? People don't realize that life insurance is a tax-free transfer. So here's what happens a lot. Husband leaves beneficiary is the wife is a husband. And then they have their children, 2 or 3 or 4 or whatever children. Consider this: by leaving your retirement account to a charity, nonprofit, church, organization, that is a tax-free transfer. In other words, it just goes to them under the current law. That just is their dollars. But you say, but I wanted to leave money to my kids or my grandkids. Then you can leave them the life insurance policies. So you can have even a little bit less than you had in your retirement account, but leave it to your kids, but they end up netting more money. And the reason
That's
is
right.
because they don't have to pay income tax on 401ks or 403bs, and they don't have to pay income tax on the IRAs. So they really come up with a very good plan to say, I have a system, my husband and wife, and they're our own beneficiaries, but we don't want to leave money to our children where they are now pushed their other income into a higher bracket.
Right. You want to leave them a true gift. You don't want to leave them a liability or a chore. Because how many times have we seen, and I think you just had this conversation recently, and you might want to talk about it, where you have multiple children that are in line to receive dollars that were never taxed. So let's say I have $500,000 in my retirement account, an old 401k, and I was drawing from it, and it made some interest, great. But I pass away. The music stops, as we say. And now I have children that are working. They have their own lives, their own spouses, their own tax brackets, their own income. Everything is their own. They're grown. And now they get this gift. And you think you're giving them a gift, but now they have a chore to say, how am I going to ingest and take on taxable income? Because I have to take it out. They can't just say, oh, you know what? I don't feel like doing it. Uncle Sam, I don't need this money. I'm doing fine. I want to let it grow, give it to my kids, my grandkids, for crying out loud. I don't need this money. In fact, I don't want this money. They say, tough luck. We developed something a long time ago, and this is Uncle Sam, called RMD, Required Minimum Distribution. And you have to take this money out because, look, we let your parents defer this money as long as they could, and then they pass, and that's a trigger. Sorry, you have to take the money out. And you say, well, I don't want it. Tough. Oh, you don't take it out? No problem. There's a penalty. And guess what? You still have to take it out and pay tax on it.
And the problem that this occurs is you may have a successful child, financially speaking, who has a great job, their wonderful income,
Right.
and then you have another person who may not have any job, and they're the slacker in the family, or the one who's the free spirit, whatever you want to call them. And you're going to leave equal dollars to both of them. Well, one only gets a smaller number. The reason is very simple, because they have to pay a much higher amount of taxes.
Right.
The other gets to keep a much larger number because they are in a much different tax bracket. Mm-hmm. Always consult with your CPA, your tax advisor, your professional, so that you can ask them, hey, here's my situation. How does it affect child 1, 2, or 3? And you might be surprised to find that the goal was to leave them each a certain amount of money, but they're not going to end up keeping a certain amount of money. Life insurance is a completely different. It is off the tax return. It is a completely different formula, and it is pushed off to the other side, which means if the children want to keep it, they can keep it. If you want to give it to grandchildren's college education, you can do that. If you want to give it towards the future of a legacy, we have seen people have children, grandchildren, great-grandchildren going to college with this bucket of money that it just continues to fund that. And there are ways and mechanisms to do that. Having a living trust is important. It gives the process a little bit smoother, kind of like a roadmap. But what it also does is it gives creditors a place to take your money. So if you have a child that has a problem financially, or you have a special needs child that is getting some government assistance, it may affect them a little bit more by leaving them big buckets of retirement dollars versus life insurance money. Sometimes it's worse, sometimes it's better. That's when you talk with your estate planning attorney and you say, here's the problem I have. How do I make sure that the dollars are equally passed? Here's another real, excuse maybe, Jeff, that we see. It's pretty substantial. Look, I've got too many other things to worry about right now. And you know how complicated and difficult it is for life insurance.
I would say that's a pretty selfish stance to take, because when you're dead, you don't have any more voting rights. Your family is the one, or are the ones that have to pick up the pieces. They have to mourn your death. Whether they liked you or not, they're still gonna, probably shed a tear or two. And then, oh, by the way, hey, are you guys done being sad? Okay, great, because we need you to sign all these forms. We need you to go. I mean, let's say some things went into probate. Let's say some things weren't, the loose ends weren't tied up, and there are some things to do administratively. And guess what? Someone has to execute on your behalf now that you're gone. And so what a chore to take on. I watched it happen firsthand. My one of my relatives' spouse, they were just dating at the time, was soon to be married, and they hadn't started their family yet. And boy, this girl, this young girl, she was the baby of the family. The older siblings, she had an older brother, older sister that wanted nothing to do with it, and the mom's estate was left in her hands. She grew up really quickly. She didn't have time to cry or mourn or be sad. Everybody else did, but she had a lot to learn. And you know what? She's a better person. She grew up pretty quickly, as I said. She's a more organized person, I think, because of the experience. So maybe there's some silver lining there, but things that you don't ever want to tackle on your own, she did, with very little help from an attorney. So all that to say was, had she had the money in the estate to do that, to hire an attorney, that would have been fantastic. But remember, those are the folks that get rich. So you can either spend a little bit of money now and get one involved at a discount, if you will, by putting that roadmap together, whether it's a living trust or some set of rules that you can control while you're alive, or you can wait until everything happens by default. And that's really an expensive way to do it.
Look, all you need is a health exam, a medical exam, and they send the paramedics to you. The insurance company, the agent that you work with, they send the paramedic to you, whether it's at work or it's weekend, in the evenings, it doesn't matter. And depending on how much you buy and your age, and it's rather straightforward. It's usually blood pressure, sometimes an EKG if you're a little older or if you're buying a much larger amount of insurance. So they have a couple of different things that you do. But what really takes place is it's all behind the scenes. They pull medical records. It's not your problem. You sign some forms and off it goes. And then behind the scenes, everybody's doing the work to make this happen. You'll have to sit for the poking and the prodding, and you'll have to give probably a urine sample, blood sample, fine. But then it's over. Then the rest of it is now done by the company behind the scenes. And they'll say, okay, hey, you are better than we thought, preferred plus versus preferred. Or, hey, your cholesterol's a little high, or your blood pressure, some of the medication, so they'll back off the rates a little bit. So you'll see a couple of things like that will adjust. And then you can say, no, thank you, I don't want to do it, or yes, I do. And why that all works together is because even during the life insurance policy, let's say you have a 20-year plan. If you have a 20-year life insurance policy, you can cancel anytime. The insurance company cannot cancel you, but you can cancel them.
Right.
You can go the entire 20 years. You can cancel after 3 years. You can cancel after 5 minutes. It doesn't matter. You can move forward or backwards, but that gives you some options as well.
Well, and I think that takes care of the part where there's too much going on or I'm too busy or it's too complicated, because you just sit for an exam and you let a licensed professional walk you through the process. And if it's too much, quote unquote, it costs too much money, buy as much as you can afford, because at least that's something towards taking care of your final expenses. And look, if you come in at a place where your health rating was maybe not the best, we've seen folks do this where they'll place the policy, they'll accept it, and then sometimes companies have a provision where they say, look, in 12 months or 24 months, if you're healthier or if you've dropped some weight or your health has improved, just sit for another exam. And if we can give you a better rating, we'll do that going forward, and that can reduce your costs as well.
Yeah, sometimes you just came off of a treatment for cancer 4.5 years ago, and they say, 5 years is our sweet spot. We're okay with that. But if you want coverage now, for the next 12 months, you're going to pay a higher rate. And if you're cancer-free, and like Jeff said, you sit for another exam, or we just pull medical records and everything else looks good, we're done. We'll reduce the rate. You go back to somebody who is at a much better rating, and you save money. So feel free to move it. Once you have it, it's in your control, not the insurance company's control. Look, I know how yucky it is to pay for something that you may not ever receive any benefits from. When we come back in a minute, I want to give you some details that you can have while you are alive. Life insurance can also give you benefits. It's not just a one-way street where it's nice. You're going to what is it, Sancho? Is that, some of you know that term. I learned that in the insurance world, where Sancho is going to be the one ending up with all the money and not you. When we come back in just a minute, Total Financial Solutions, Safer Money Hour. I'm Arif Halaby. That's Jeff Gerard on AM 1220 KHTS.